All right. Welcome back to the Madison Advisory AI Podcast. I'm your host, Amanda Verner Thompson, founder of Madison Advisory AI, where we help organizations turn AI into real operational leverage. Today, I'm joined by Thomas Rush, a venture investor who spent more than a decade working at the edge of frontier technology. Thomas leads investments at Consensus Mesh and is the co-founder of Systemic Ventures, backing companies at the intersection of blockchain, AI, and emerging technologies. We're going to talk about what working with hundreds of startups has taught him about building resilient companies, why distribution often matters more than raw technology, and what leaders in complex industries can learn from frontier tech. A lot of exciting topics on the way. Thomas, welcome. Great to have you today.
Thank you. Thank you for having me.
I think for our audience, it would be a good starting point to share what the through line is of your career from post-Carina, New Orleans to where you are today.
Yeah, certainly. I guess, the core through line is really economics. I studied economics in undergrad, eventually worked in economic development in post-Katrina, New Orleans, as you said, focusing on effectively job creation in the region, but that boiled down to a lot of other things, including even just water management, because water, that was the big risk that was on the top of everyone's minds. Post-Katrina was, why would you want to invest the resources of a company into a region that was prone to flooding? So we actually started addressing water management as a result. And I think it's a really good example because kind of the ultimate through line to all the work that I've done is, I think it's really interesting economics as a discipline overall, primarily because it boils down to how we allocate resources across the human population and primarily the ones that are necessities. Most people don't think about how water is allocated because it comes out of their faucet, but it is obviously extremely crucial.
Right.
And then obviously you can go up the spectrum to luxury goods, and that includes economics as well. But I think that a number of decisions and the complexity of those decisions that people are making are all underpinned by effectively economics at the end of the day, finite resources and infinite wants. And so that's what I've always focused on, is just kind of, I think, is an incredibly complex, interesting system that we're all a part of, and enjoy spending my time working in it.
That's great. And really interesting how water evolved as part of your story there. In terms of finite resources, how would you connect cryptocurrency as being a finite resource of sorts?
Yeah, I mean, I think, the Bitcoin maxi would say that certain coins can be minted with only a finite number of them, and then they kind of become scarce, etc. I think the other take on it that's a bit more broad would be that, cryptocurrency and blockchain tech more broadly provide us a net new way that's never been possible before to identify ownership of resources, identify and transfer value, obviously digitally across the globe. So in a world where, speaking of finite resources, where, people used to transport, whether it was seashells or gold, etc. Now being able to do that seamlessly across borders 24/7, it unlocks a ton of value, particularly for people who are not able to access those networks or not able to access those economies previously. It obviously comes with some downside, and people are quick to criticize crypto for various use cases, but none of those use cases, speaking of crime or what have you, cash is subject to the exact same problems. So I think it's a net benefit to society as a whole.
And just before we jumped on, we were sharing a little bit of tidbits of developing fear in childhood in our children. How would you associate fear with crypto? Should this be something that the general public is afraid to venture out into, or should we go for it, if you will?
I'd say it's probably somewhere in the middle. Certainly go for it, but to a known quantity, meaning, minimize your risk. So the classic, this was a couple years ago during an earlier cycle, during the Bitcoin hype cycle, but everyone was, kind of asking me if they should be investing, et cetera. And it's kind of similar to any other asset, I view it, at least speaking purely on the financially end of things, and not financial advice, of course. But you'd want to limit your risk there as a person. And one way to do that would be to minimize the amount you might invest. Another way would be to learn about something that's probably going to impact the global economy. I mean, it kind of equated to, understanding the financial system overall is usually helpful to people who are looking to, save money, invest, retire, etc. It's effectively kind of along the same lines in terms of educating yourself so that you're better prepared for the future that's effectively already here.
And wearing my investment banking hat, I would say education is always key, and we are for certain not giving any financial advice on this podcast.
Yes.
but 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 it is great for everyone to educate themselves in crypto in general. I thought one interesting thing I learned from our conversations is really how it does affect the developing world in some instance. Can you expand upon that to some degree?
Yeah. So, and this comes up in conversation just with my peers socially a lot because most of us, I'm based in New York City, financial center of the world, and also just obviously in the US, where most people have access to a well-regulated, very fine-tuned financial system. We've got credit cards, bank accounts from a bank that you can trust with the global reserve currency is kind of the underpinning currency among all of it. We've got applications, Venmo, fintechs, etc. So there's not a lot of friction for us just day to day. Everyone can go to the store and do things quite easily, tap to pay, etc. To your point, though, the part that people miss, I think, is, and it kind of goes back to what I said earlier on, exposure to this global economy or even just exposure to US dollars can be really critical. If you live in a country where inflation is, at a crazy high rate and just increasing rapidly. And the dollars you earn today, or sorry, I should say the currency you earn today for your job is worth less, quite literally, the following week or the next month. It's very hard to establish savings. It's hard to understand or even know how you should allocate the money that you've just recently earned. And so then being able to using just a mobile phone and access US dollars and save in US dollars or even go further and access US treasuries potentially by using some sort of on-chain product, suddenly you've opened up an entirely different kind of financial path for someone. And I think that's really crucial. And it's just a story that's missed very often because we don't see it day to day. And when I say we, I just mean, kind of people working in the US where I'm based.
Right. And a lot of people in general in the finance world in the US, we don't think about how that could translate to other countries and the person earning money there. Speaking to earning money, you've worked with quite a few different founders. Is there one general lesson that you've learned from the 400 plus startups that you've worked with and invested in?
Yeah, I mean, there's a few, and I've been asked this before, and it's frankly it's kind of a tough question because everyone's different, etc. But I do actually think, having thought about it a few different times, that it's counterintuitive. But I would very often, as an overarching statement, say go slower. Move fast and
Interesting.
break things is a common quip that people say. It sounds great, it's sexy, it's disruptive, etc. But frankly, most startups fail because they run out of money building the wrong thing, or they are building the right thing for the wrong market. And if you do that faster, you're just more efficient when it comes to driving your company to $0 in the bank. So you can be efficient at the wrong thing, and then you're just accelerating the problem you're facing. And I think some of it's just a mental state for founders who have to deal with a lot of complexity, and there's a huge open world of decisions to be made. Some of it has to do with just, the week to week sprints. But I do think that being more kind of well-researched, intentional around what it is you're building and who you're building it for, and making sure that that's really the right product, the right market, et cetera, right? That all these
Hmm.
these kind of the metaphor I like to use is, and it's not mine, but is you want as detailed a map of the territory as possible. So some founders kind of know that first layer out, the first layer of the onion around them. They know their immediate environment, et cetera. But if you can see the second, third, and fourth order effects of decisions you're going to make, understanding that map in a really detailed way, taking the time to do that can mean the difference between succeeding 18 months from now and going the wrong direction from the outset.
Right. Yeah, that is a good way to put it. It's interesting because there is almost a dichotomy. How detailed of a map do you want? Are you going to get too bogged down and maybe take too many side streets when there was really a faster route to get there? But when you talk about going slower, and I know you have quite a lot of experience with AI companies as well, how do you tell an AI founder to go slower?
Well, it's honestly, it's something that I would say it's applied to your question because it's kind of a macro theme, right? That a lot of companies kind of, you see it in retrospect is what I mean. You see that
Right.
insight in retrospect only, and it's hindsight is 2020 type of thing. So it would be tough to frankly tell someone that directly up front because it is kind of day to day. You don't want them to slow down their day to day. You don't want them to slow down their decision making. But I do think that there's kind of a balance between doing the research and also making sure that they're, I guess, connecting the long term with the short term is the best way to put it, in the sense that you want to move fast. You want to, continue to learn, et cetera. I mean, a lot of founders will say that a startup is just a machine you're building. The goal is to learn as much as possible in the shortest amount of time in the shortest time frame possible.
Hmm.
And so I think that's all true, but you need to make sure that as a founder, the slowdown part you're doing is to pick your head up from the sand, look around, make sure that you're going the right direction, make sure that there's not some macro headwinds you're about to run into, to make sure that, ChatGPT isn't going to release the next version and blow you out of the water. Like being aware of those broader surroundings is, I think, kind of the slower version of what I would advise. And then the day to day, you of course still need to deliver because you've probably got 18 months of runway to get to that next milestone, whatever it is.
Right. So it really is you're keeping the week to week sprints as you referenced before, but while staying well aware of your surroundings, macro
Yeah,
environment, and what you're working towards.
absolutely.
That being said, what would you say from your experience and a wide range of experience, what really differentiates stagnant startups versus those who have a lot of momentum?
I do think it is being able to make decisions very quickly. And, I'll steal Bezos's kind of cliche thing, or it's cliche now because it's really smart, which is understanding if it's your decision is a two-way door or a one-way door. And it goes to, if people aren't familiar, it's basically, if you're making a decision and it's a two-way door, meaning you can make the decision and then back out of that decision, make it as fast as possible because you could make it, go learn the process. Maybe it was the right one. I mean, ideally it is because that's why you made it in the first place. But if it's the wrong one, you can reverse that decision relatively easily with, X amount of cost. If it's a one-way door, those are the ones where you want to make, harder, more methodical decision making processes. And there's really very few decisions that are one-way doors when you boil it down. I mean, even product architectures get rebuilt. I got an investor update this morning and that was, hey, we completely refactored our code because we ran into XYZ issues on our kind of the deployment with their clients. And yes, that was hard, but it also wasn't the end of the company. They took 6 weeks. They went heads down and kind of rebuilt their code base from more or less the ground up. Obviously reusing components, etc. And so yeah, I would say that's kind of like the key to understanding which decisions you really can take your time on and need to because it's somewhat existential.
Really, what's reversible and what is set in stone as you're moving
Exactly.
forward? Do you think in, I guess, what I have been referring to as the new world, the new frontier of technology, do you think more and more decisions are a two-way door given how fast the world is moving? Or is it almost the opposite? Things are moving so fast. Once you go down a path, it's really hard to backtrack.
No, I think most are two-way doors. I think the ones that are more one way is if you're spending capital and there's obviously opportunity cost there. So hiring is another good one. If you're a seed stage company with 18 months of runway, it takes you a couple of months to hire whatever it is, your chief revenue officer, and then you hire that person. You may not realize that they're the wrong person until 6 months in. And at that point, you're halfway through your runway. So it's
Right.
effectively a one-way door at that point. Like, yes, you can hire a second one, but now you're on the back end of your cash before you've really pivoted back to a different chief revenue example
Yeah,
officer
that's a
using.
great example. That's a good way of thinking about it
Yeah,
because it does really come down to capital in a lot of ways in what your runway is.
precisely. Yeah. And then I think the day-to-day product decisions are more, I mean, a lot of those are one-way doors because again, it's software. You update it, you change it. Even hardware can be changed with the next version. There's some opportunity cost, right? There's a bit of a sliding scale here, but not spending. I think the death knell is when you spend 8 or 9 weeks making a decision where you could have learned the lesson from the decision in the 8 or 9 weeks instead of, debating about it as a team.
Yeah, and I've run across that quite a few different times with some of my clients in investment banking and especially healthcare systems. There's a lot of overanalysis where y- could be out in the market, could be testing some outpatient centers and things like that if it didn't take as much time to build up to those decision points.
Yeah. And if you don't mind me extrapolating on it, the other thing is to look for gray areas, I think and that's often missed. Whereas, you may say, all right, this decision feels, kind of like a one-way door. Or it is important. I thought of it in the healthcare space because of what you were saying. Like obviously there's elements where you have to be really careful. There's regulations, et cetera. And that's true with some of the companies we work with as well. But you don't have to take what's kind of given to you on the platter and then make the decision based on that. Like there's again a spectrum. Like maybe you remove the regulatory part and go out learn what you need to with like a smaller, with a variation of that experiment where it's like, great, on Thursday we can just ship this. We at least get some feedback from users. We're just going to send out an email newsletter instead of a whole product, right? Like kind of changing
Yeah.
the constraints you're working with, I guess, is the point, so that you can be a little bit more flexible and again learn while you're keeping the broader context.
Do you have a stance or as an investor where you look at AI in heavily regulated fields like healthcare, like finance in general?
Yeah, I mean, it's tough. I think one, and this is not going to be controversial. I think, like most investors, we're a little cautious about them because regulations can change and kind of are changing. Other jurisdiction specific, and then for us specifically, we're not regulatory experts and don't purport to be. So I wouldn't say we necessarily steer clear of those companies by any means, but we would really need the founder to kind of to have founder market fit in the sense that they've come from that industry. They've proven that they really know the regulations, or they've already acquired a great chief compliance officer or whatever the role
They have
is
the
for.
team building up to that they can be nimble, and that's in a world where it's very hard to be nimble, they have the right depth and background in their team to be able to handle it.
Precisely. Yeah. And that adds up for the type of investing we do anyways, which is pre-seed and seed primarily. So we're investing in the team to begin with. So we're always looking at things through that lens versus trying to assess whether or not a very particular product is going to run afoul of a very particular regulation.
So that essentially answered my next question, which was going to be, do you just see yourself investing in founders more than the idea or the product the founder has?
We do, yeah. And some of it's relatively well-known wisdom, but also just hard lessons learned on our part where we've written checks since I joined Consensus in 2017, and the product almost always changes.
Mhm.
There's few exceptions where they strike oil on the first go at it, and they know exactly what they're building and they find product market fit. That's fantastic, obviously. But more often than not, they pivot along the way. All the famous scenarios where one product was gaming chatbot and then turned into Discord servers and is now just a messaging platform, or like those types of things
Right.
where there's pretty severe pivots. You need to know that the team you've invested in are the ones to steer that product forward, kind of regardless of what market they're pursuing.
And when you think about the various investors that you've come across, and if we have a listener that's thinking about founding a company, what are the top 2 to 3 characteristics you think make a strong foundational founder?
I would say like number 2 and 3, for me at least, are kind of the obvious ones, right? You again, kind of founder market fit. Do they actually know this business? For example, I got a pitch, like got an introduction to a founder the other day, and it's by no means the founder's fault, but like you could tell he hadn't really truly worked in that industry, hadn't built a product for another company in that industry, and some of my questions were able to kind of poke holes in the plot line that way, and it was very very obvious. And so call that number 2. Number 3, I would say, would be proving that they've done, and this is a personal one that I kind of latch onto, proving that they've done everything they can do without capital. So very often founders will come seeking capital and they say it's for XYZ. And half the time, X and Y could be done with $0, right? It's just going out to the street to talk to their target user, or it's building a prototype type using some free tool online, or whatever the case may be. So that's just like the grit portion of it, right? Like they should be pushing every single boundary as far as possible. And then going back to number 1, I think emotional intelligence is underrated as a criteria overall.
Okay.
The ability to take feedback, the ability to not take things personally. Going back to pivoting, if you have to pivot your entire company and you take it personally, that's not going to be good for anyone. You need to manage high stress scenarios with employees. There's so many things that tie back to somebody being able to stay calm while they're at the helm that I think it's critical.
Yeah, I've seen that throughout my career. And, whether it's undervalued or not, I've always thought EQ can be higher than IQ in some instances. But one of your examples did just remind me of Shark Tank. Can you think about some of the companies that go on there, one, just to test out valuation, but 2, for advertisement when they really don't need the additional capital?
Yes,
They want to see what the market thinks about their product. I guess that's one way to do it.
that's right. And to touch on, I don't know, one of the other points I made, pretty savvy of them if they can go get some free advertising. So yeah,
Yeah, yeah, we're not faulting them for that.
yeah,
Just
yeah,
a
exactly.
nuance to it. What do you think has been some of your hardest moments working with founders?
Honestly, it's usually when I've developed a relationship with the founder, you're close with them, you're on the same team, but then, and it depends on the scenario, right? If you're a board director or not, but very often if you're just a shareholder, you don't have the same duties as a board director, obviously. And then there come times when your interests diverge. And, we've always, this is wisdom taken from our general counsel, who's phenomenal. Very often when we're like trying to set terms for investments or negotiations, etc., we really just say ultimately we want to be in the same boat as the founder, because then our interests are as aligned for as long as possible. Usually that's to the benefit of everyone. Sometimes though, obviously times come up where those interests diverge because of share class, because of, what the founder wants to do with the company versus financial return, et cetera. A million
Mhm.
examples. And yeah, those are tough when you have a good relationship. You've worked closely as effectively colleagues, but now you're negotiating against them. And you also know that after this is done, you're going to continue working together as colleagues. So
Right.
it's a really unusual relationship that most people, I don't think, get to experience, where you're kind of flipping roles from colleague to negotiator across the table with the same person, depending on the week, and depending on what's happening with that company. But that can get, I think, difficult. And yeah, I guess it goes back to the EQ point, right? Being able to navigate that is I think, a really important skill for investors as well. And it's why I always get a little leery or kind of like concerned when I see investors who it doesn't appear have that skill set, because I can only imagine what it's like to work with them on the other side. Yeah.
How does your negotiation style change when you're an initial investor versus what you're describing, really like the ongoing teammate, colleague as the ongoing partner?
Yeah. I mean, again, so having focused on kind of token design for quite some time and crypto economic companies, there's always a lot of talk about incentive design and kind of aligned incentives, et cetera. And so whether it's the best path forward or not, but I often kind of use that framing in the sense that even during an initial negotiation, I guess this is kind of classic wisdom, but trying to find the areas where of common ground where it's like, here's where we are aligned. Let's, try to get to a good agreement on those things. And then hopefully the differences are very few and far between, back to we're trying to get into the same boat as the
Mhm.
founder. And I think, usually it's kind of almost an educational aspect of that, where we're explaining how, XYZ terms would play out and how that does actually make us aligned with the founder. And and I think then also setting a hard line and explaining, again, maybe it's I don't mean to be diminutive, but like there's an educational element of, I'm just in a role that I have shareholders or stakeholders as well that I'm kind of representing. It's not just me personally trying to dig you out of X, Y, or Z economic outcome. I'm acting in the interests of my stakeholders, et cetera. And then ultimately, yeah, navigating that relatively complex conversation versus the colleague the colleague conversation, which I think is much more convivial. And then I can be fully wear the hat with their company logo on it and go full steam ahead, arm
Right.
in arm, just purely working on their behalf.
It has to make your career just that more interesting that you get to wear 2 different hats throughout the day, probably even.
Yes, yes, definitely.
Pivoting a little bit, and we did touch on AI and technology and your background, but how would you view the tech world in terms of tech innovation versus, I don't know if it is versus, and distribution?
I think, particularly with AI, it's evolved over time and very quickly over the past, call it, basically 3 years. In my opinion, distribution matters tremendously. So, when you think about, like, a really good example is that ChatGPT came out as an application, obviously from OpenAI. At that time, or shortly after, Google kind of declared code red internally within the company. They saw it as effectively as an existential risk, and they knew they needed to do something about that. Fast forward 3 years later, Google's obviously delivered. Google also has kind of famously good distribution with all their products globally. And now OpenAI has declared their own code red because they see the tables have turned a little bit. They're doing a good job of, in PR, of spinning it and saying, hey, it's just a way for us to refocus our efforts. OpenAI, that is.
Mhm.
But I think the reality is that that they see folks with large networks of distribution, kind of competing very, I don't want to say easily, but competing very well because they already have captured customers, et cetera. And OpenAI needs to go acquire those customers and basically, get them away from Google search, which everyone's been using for 20 years. So
Good luck.
distribution's incredibly important. And one other example, just to illustrate the point, and I'll make this one way quicker, is there's open source models out there that are phenomenal and at par, at least on the benchmarks, as the closed source models. But your friend who looks something up using AI on their phone while they're out walking around does not use an open source model. They use the one that has the distribution plugged right into their phone. It's just like simple examples that kind of illustrate the broader trends, I think, across the industry.
And how do you see this as it impacts really information security and verifiable sources and things like that?
Yeah. So it's a well-timed question. I spoke with a portfolio company yesterday who is building something in this space. Their name is Apex E3, and they're seeing a ton of traction because they are building effectively a number of products, but they're all privacy first AI products. So they've sold to large financial institutions because obviously, if you're a huge asset manager, you don't want to load your proprietary documentation into OpenAI and just for the risk that it gets ported into their model. If you are a company building really kind of leading edge tech, you probably don't want to use Claude for code generation because again, you feed that code in, there's a good chance that it gets swept up despite terms of services, et cetera. I think people are realizing that there's risks there. And so Apex E3 is actually, building things in those spaces where they're saying, hey, look, we can deploy these on-prem, you can view it, you can understand exactly where the garden walls are for this product. And then when you use it as a company, it's perfectly private and confidential to yourself. It's like huge number of use cases across those industries, right? Whether it's code gen, financial, insurance, medical, et cetera. And I think people are, ChatGPT was a great way to wake people up to the use case. And then there's kind of a bit of a pendulum swing in the other direction to, in the sense that people are doing it more intentionally and considering the trade-offs they're making.
Do you think there's any relation to distribution, large amount of distribution, and ability to retain privacy and information?
Yeah, I mean, absolutely. There's a convenience trade-off that's often discussed in circles. And the classic example is that most people don't, they choose convenience over privacy. Granted, those are individual users. Very often, companies will choose privacy over convenience and do so because it's to their own benefit long-term, obviously. The other kind of interesting stat that I always like, many people will be familiar with this, the ask app not to track pop-up that you get on iPhone. 95% of people select that they ask that the app not track them, right? But that's also, at least what you can infer from that is that it's because the notification is showing up. It's not even like the person's not actively needing to go seek a privacy. It's very convenient for them to just press one button or the other and you'll choose privacy because it is that convenient. So I think that's the level of convenience that products need to get to, where it's just a toggle, right? It shouldn't be go download an open source model, set up your own reg system, deploy it in the cloud on a TEE, secure server on AWS or deploy it locally. Like now you're hiring a developer full time just to get some privacy out of your application.
Right. And I have to say I am guilty of that too, the convenience factor. And I probably wouldn't look into it any more than tapping the one button that pops up, but I'm very grateful for it.
Exactly. Well, quick plug. I'm not affiliated with this at all, but Proton is a very big privacy organization. They do VPNs, a number of privacy-oriented products, and Proton Mail is another well-known one. They just launched Lumo, which is a kind of ChatGPT competitor that is privacy first.
Okay. Well, I think that'll translate well, especially now that we've delved so much into privacy. But I think it is a very relevant topic when it comes to AI and how quickly the market's moving. But some people are missing that gap of lost information and privacy once you start giving away too much, if you will. Is there anything throughout your career that has really surprised you, or what has most surprised you throughout your career?
I think it just goes to show my naivete, but the you know, the way that and this sounds more pessimistic than it's meant to, but the way that disruptive and very innovative technologies end up kind of regurgitating the same system that we had prior to them. Unfortunately, like there are some benefits, but one of the big criticisms of blockchain tech is that it made people who were already relatively wealthy, educated, had access to resources, just made them wealthier, which is true to some degree. And like, I think where there's more nuance to it. Obviously, that's a bit reductive, but that also is true to. And similar with AI, it's some people claim that it's going to be a very great kind of equalizer, access to information, similar to what the internet was supposed to be. But and the internet did have, depending on who you ask, I think a ton of benefits, did provide a lot of access to information. You obviously have the misinformation side of the coin. And then similar from like an economic perspective, right? Whereas most of the value from AI going so far, it's to the already successful companies with, go figure, distribution. So and it's showing with the S&P. I don't know the exact stats, but the whatever the latest stat is, right? 40% of
Mhm.
that is made up of the top 8 companies. Or again, don't I'm
Right.
just
No,
saying figuratively. Yeah, yeah.
yeah,
So
that is interesting, and it does seem, especially when it does come to AI as well, it's where the capital is. You have the capital to invest and grow, and then you're benefiting. Now down the line, I think with distribution that may equal out to some
yeah,
degree.
exactly. Yeah, and it's going to be a trade off or kind of this play between how much people are being influenced by their AI search results versus how much benefit they're getting from it. A friend of mine saved money on a plumber because they had AI walk them through how to fix their boiler. Probably saved $800, which is great. On the flip side, you can imagine a world where advertising embedded into AI responses leads someone down a path and there's some influence there. So where the net benefit between all these things is obviously TBD.
That's great, especially on the plumbing. I think as far as we've gotten in my household is meal planning, so
Right.
I'll add that to our list.
Yeah, certainly.
But in terms of systemic ventures and where you're looking, what types of companies really excite you the most right now, and what are you looking into?
And this is a very high bar. So by no means should founders, if they're listening, expect that this has to be them for us to have a conversation. But the highest bar and kind of the ideal founder is somebody who's building a new primitive, introducing a new primitive to the world. And that's kind of a word used in crypto circles a lot. But what I mean by that is effectively a new way of operating or a new way of creating value. For example, we wrote a very small check into Pluralis Research because it was a very competitive round. And the reason it was so competitive was because they're building something entirely new, brilliant team. So they're building this multi participant training of foundation models, right? So you imagine what OpenAI does. They're doing something similar. But whereas OpenAI does it as one company, Pluralis Research is doing it where no single participant that is contributing to the development of that model has the entire copy of it, similar to federated learning.
Okay.
So, point being, it's like this co-owned foundational model, and you can imagine a world where if they were able to develop a model that was a successful model plus products, et cetera, but where they're creating billions of dollars of value, the average user could contribute data, contribute compute, other resources potentially to that network and to that protocol, and then receive value in return. Classically instead of the other model where kind of all their value gets hoovered up by a for-profit company, obviously. That's a long-winded example to say that we are very we're very in support of companies doing pretty wildly ambitious things, and that's actually who we prefer to speak to. So if
Okay.
you're listening and building anything that you think is out of left field, we'd love to hear it.
That's great. And that is a high bar, the new primitive. But I'm sure there are ample amount of founders out there that are aiming to be wildly ambitious and would love to meet with investors like you to really take it to the next level and have the capital to be able to do that.
Yeah, yeah, I completely agree. I'm sure there's hundreds, so would love to meet them.
Well, I appreciate you taking the time with us and our audience today. I think we've touched on a lot of great points and appreciate all of your insight.
Yeah, no, thank you again for having me. This was great.
All right. And hopefully, listeners, you can reach out to Thomas Rush. Is there a best way to reach out to you and learn more about you?
Yeah, absolutely. I mean, pretty easy would be Twitter. You can just ping me. It's at Thomas underscore Rush. And then I'm available. You can go to the Systemic website. My email's there as well.
Okay,
The
great.
website, sorry, the website there is systemic.vc. Very, very easy to remember.
All right, sounds good. Thank you again, Thomas.
Thank you.